About the GDP deflator and its uses. Key points. The GDP deflator is the ratio of GDP measured at current prices, nominal GDP, to GDP measured at constant prices, real GDP. The GDP deflator automatically incorporates changes in the consumption pattern and structural transformations in the economy, unlike other fixed basket price indices like the Consumer Price Index or CPI, because the GDP inflator includes all goods and services produced and not just those in a fixed basket. Additional information about the GDP deflator and its uses. Overview. The GDP deflator, also known as the implicit price deflator for GDP, is a measure of the level of prices in an economy. It's a ratio of the value of goods and services an economy produces in a particular year at current market prices to the value of the same goods and services produced in a base year, with the value expressed as a percentage. Role in calculating real GDP. The GDP deflator plays a crucial role in distinguishing between nominal GDP and real GDP. Nominal GDP is calculated using current market prices, and thus it can increase either because of increased production or increased prices. By dividing nominal GDP by the GDP deflator, one can remove the effect of prices to calculate real GDP, which reflects only the volume of goods and services produced. Comparison with other price indices. The GDP inflator is often compared with other price indices like the Consumer Price Index CPI or Producer Price Index PPI. While the CPI measures the prices of a fixed basket of goods and services bought by consumers, the GDP deflator measures the prices of all domestically produced goods and services in an economy. This makes the GDP inflator a broader measure of inflation. Economic indicator. Changes in the GDP inflator reflect both the prices and the goods and services available in the economy at different times, making it a key indicator of economic performance and inflation in the economy. Limitations. While the GDP deflator is a useful measure, it has its limitations. For example, it does not take into account the underground economy or unrecorded economic activity. It also does not consider the quality of goods and services, and it assumes that the economy's output is purchased domestically, which may not always be the case in open economies.